Okay, as a typical economist, I thought of a joke. I wanted to make a joke, but couldn't think of one because of my dry sense of humor. I'll just start by saying that the event is hosted in partnership with the Hanns Seidel Foundation, and their director for the South African unit would have loved to be here, but he can't join us, unfortunately. Um, Now, I just want to maybe quote Daan Steenkamp from his paper, Gaps in the South African Inflation Target Debate, where he says that there is surprisingly little South African research available to inform discussions into how to improve South Africa's inflation framework and what the target should be and when it should be lowered. So this event is multiple fold, but one of the reasons we've had it is to inspire our students to potentially do more research on the subject because of how unfortunately low the amount of research on the topic is. And it is for this reason that we've also started a student society called the Wits the Wits Society for Macroeconomic Thought Leadership, which is in the process of being developed. We've got about 80 members, and this is our launch event, so welcome to it. So amongst the other purposes of the event are, like I said, inspire students to do more research on the subject and to give analysts and commentators such as yourself a chance to engage on the matter. We also want to have this serve as a platform to start a partnership with yourselves. Because like I said, there is not enough work being done on macroeconomic thought leadership in South Africa, and we would like to engage with you to see if you can maybe give us money or engage with us in another way to help us to support the work that we do as the School of Economics and Finance and as our society, and then to also give our students an opportunity to network with yourselves. So please do stay for the networking session afterwards. I want to just say that when you walk out of here on this floor, the first, I think it's the first or second door on your right is the male bathrooms. And if you walk further down, there's another one just before the stairs, which is for the females. And then with that, I want to please welcome our very lovely head of the School of Economics and Finance to please open up for us. Thank you.
Thanks, McKinley Mitchell, for those introduction. It's my distinct honor and pleasure to welcome all of you this evening, those present here in person and online. Thank you for making yourself available for this evening of intellectual engagement. I'm sure I'm heard, right? I'm a lecturer. Primarily, I don't need mics. I can, I'm one of those people quite comfortable lecturing in the same venue without mics. So yes, as I was saying, my warm welcome to all of you, both in person and online. Today, as McKinley indicated, the topic of discussion is to review and debate on the Reserve Bank's proposal to move from its current bandwidth of 3 to 6% as its inflation target to a lower 3% inflation target. We have with us this evening an august panel comprising of esteemed academics specializing in the area of macroeconomics and monetary policy. Also with us are researchers, industry practitioners, as well as people with policy experience at the most highest level. I'm saving the introductions for McKinley to follow, so let me not bring in much more details about the panelists at this point. My role basically today would be to welcome you and also to provide you a brief context so that we open up the evening for further discussions. And of course, we have, aside from the panelists, an august audience comprising of think tanks, members representing civil society think tanks, and of course, most importantly, the future specialist, as McKinley said, comprising of our students. And I'm expecting a robust engagement following the thoughts from the panelists with the audience as well. So to provide a brief sort of backdrop, we are all aware South Africa has a much higher level of inflation target compared to its trading partners and peers. And that is often cited as the most sort of popular reason to review our inflation target. But obviously what we need to keep in mind is also that South Africa has much higher rates of unemployment and a very unimpressive, to put it mildly, rate of economic growth compared to people or countries of its own category, upper middle income group, and its trading partners. So within this context, when we debate and discuss a matter of reducing the inflation target, the core questions that I'm sure today's discussion will bring forth would be, one, is a lower, firmer inflation target the necessary catalyst to enhance the policy credibility and provide an anchor for inflation expectations in order to unlock our long-term growth potential that the economy so desperately needs. On the other side, the question is also regarding the risk associated with this in terms of the sacrifice ratio that it may entail in terms of enforcing a lower inflation target. And the credibility of it, especially in the context of supply side constraints, both internal and external, often that the country faces as growth constraints. There are, I'm sure, compelling arguments on both sides, and I'm sure we will get to hear them. But ultimately, it boils down to the simple question of the various transmission mechanisms and their relative impact. So very much it boils down to the empirical evidence within the various obvious theoretical paradigms. And I'm hopeful and I'm sure that our academics on the panel will provide us with both the theoretical frameworks as well as the empirical research evidence that will be presented today. But we're also equally looking forward to hearing from the practitioners and the industry specialists the pulse, the market pulse, and possible responses to these policy shifts. And of course, we are equally looking forward to understanding basically the fiscal policy side and the alignment with fiscal policy for such a policy, monetary policy change towards a lower inflation target. I'm sure these profound questions will be debated and discussed, and each of these will have exciting, far-reaching implications. And I hope we go away this evening with a better understanding of the implications, but also provide inputs for policy making to the larger context within the country. This evening, I must flag, is also special for another reason, and McKinley has mentioned, and that is the initiative shown by our future macroeconomist in terms of setting up a society to discuss macroeconomic issues going forward within the university environment, but also engaging with the external stakeholders within the country. So to me, that has been the single most important, exciting fact of today. The leadership shown by the students in conceptualizing this event and also organizing it. The attention to detail that McKinley has put in, and his team, McKinley and his team, has put in to this event has to some extent frustrated my logistics team, but also made us appreciate just the sheer amount of effort that you have put in behind this. Before I conclude, I wish to thank our event partners, Hanns Seidel Foundation, for the generous sponsorship as well as active engagement in the planning of the event. It's unfortunate that the director could not be present, but Karen has been providing us with day-to-day support and collaboration. We are very happy that, Karen, you could join us. I would also like to thank the panelists for making time to be present with us this evening. And as always, our Dean of CLM faculty, Prof. Cohen, thank you for making time to share this evening with us. On behalf of the entire school, thank you all for being here today, and I wish you a stimulating, insightful, productive discussion to follow. With that, thank you, and I hand back to McKinley.
Prof, you forgot your phone. Thank you, Professor Uma, for that. Thank you. I just want to, before I introduce our panelists, say that we've intentionally invited some folks. You were not chosen at random. We chose you with intention because we believe that we can partner with you and you add a lot of value to the economics fraternity. Journalists, academics, analysts, business folks, let's engage, please, after the event in our networking session. Okay, now for the fun stuff. I'm going to introduce our panelists one at a time. Dr. Creamer, who is our home economist, if he can please come up, he's going to moderate the panel for us. Shannon Bold oversees and maintains the Bureau of Economic Research's macroeconometric model, which is central to forecasting South African economy and developing baseline and alternative scenarios. Her work at the BER includes analyzing monetary policy dynamics, inflation trends, and the South African Reserve Bank's evolving approach to inflation targeting. She recently co-authored an article in the Business Day exploring the implications of a potential shift towards a 3% inflation target and its impact on economic growth, fiscal sustainability, and policy credibility. Through her research and forecasting, she contributes to the public and policy debates on inflation, repo rate changes, and broader macroeconomic stability. Before joining the BER, she gained experience in Economic Policy Unit at National Treasury and the Public Investment Corporation's Research and Project Development Team. She holds a master's degree, cum laude, from the University of Pretoria. Professor Philippe Burger is the Dean of the Faculty of Economics and Management Sciences at the University of the Free State since 2022, and Professor of Economics since 2007. He is a 2016-17 Fulbright Exchange Scholar at the Columbia University. Since April 2022, he has been a non-resident senior research fellow at the United Nations University World Institute for Development Economic Research, in which, in his capacity, is lead for the macro fiscal work stream for the SA Tide 2 project. In addition, he has been a visiting scholar at the IMF and seconded to the OECD to work on public-private partnerships, a past president of the Economic Society of South Africa, and former member of the South African Statistics Council. From October 2024 to January 2025, he was the acting Deputy Vice Chancellor Academic, and from July 2019 to June 2022, the Pro Vice Chancellor for Poverty, Inequality and Economic Development at the University of the Free State. He's written numerous scholarly books, articles, and working papers on macroeconomic, public finance, and fiscal policy, including a recent UNU-wider working paper on 25 years of inflation targeting in South Africa, going from 6 to 3%, question mark. As you can tell, we've got some pretty big guns out today. Mamokete Lijane is a professional with 24 years experience as an analyst in financial markets. She is the strategist in Global Markets Division at Standard Bank South Africa. She has a business science degree from UCT, an MBA from Gibbs, and is a CFA charter holder. Prior to Standard Bank, she worked at ABSA Corporate Investment Banking as a strategist on fixed income desk on the fixed income desk. Before that, she was the macro strategist at Aluwani Capital Partners, and prior to that, ranked fixed income analyst. Her career spans all areas of non-equity investment research, including macroeconomics, credit, and rates on both the buy and sell sides of investment business. Mamokete is a member of the Presidential Economic Advisory Council, the chair of the Board of Economic Research South Africa, and an op-ed columnist for South Africa's premier business paper, The Business Day. She has a deep interest in the intersection between public policy, economics, and financial markets. Mr. Nhlanhla Nene is the chairman of the board of Thebe Investment Corporation and has contributed to some of Thebe's most strategic decisions made during his tenure as Thebe's resident advisor from May 2016 to February 2018. Furthermore, in 2020, he was appointed as non-executive director to the board. Mr. Nene is the chairman of the European House Embrosity Africa and chairman of the Old Mutual Superfund Management Board, as well as the chairman of the Council for Health Service Accreditation of South Africa. He is a member of the Advisory Council of African Agri Council. He also serves in a diverse number of entities as non-executive director. Mr. Nene holds a BCom honors degree in economics, an advanced diploma in economic policy from the University of the Western Cape, as well as a diploma in marketing management from DMS, a certificate in economic policy from the University of South Africa, and a certificate in macro and microeconomics from the University of London. In his role as a member of the Portfolio Committee on Finance, he participated in the discussions that culminated in the adoption of inflation targeting as an anchor of South Africa's monetary policy, and further participated in regular consultations with the South African Reserve Bank while serving as Deputy Minister of Finance and later as the Minister of Finance. Daan Steenkamp. Dr. Daan Steenkamp is the CEO of Codera Analytics. He is an econometrician with previous experience at the South African National Treasury and the Central Bank of South Africa and New Zealand. Daan also serves on the Statistical Council of South Africa and is associated with the Economics Department of Stellenbosch as a research fellow. He is an active researcher and writer of a range of policy and macroeconomic questions. His team at Codera Analytics has recently produced a paper in February entitled Gaps in the Inflation Targeting Framework to help advance the debate about South Africa's inflation target. And today, he also published another paper titled Introducing a New Measure of Inflation Pressure for South Africa. Both are well worth reading. Thank you very much.
All right. Thank you very much.
One thing, sorry. If there are any technical issues for the people online, just use the Q&A section to raise it and we'll fix it. Thank you.
Well, welcome everybody. Let the show begin. 25 years ago, after the Asian crisis, we adopted the inflation targeting framework. And now there's some serious debate around whether it should be tweaked and should be adjusted. We've got a great panel of academics, economists, practitioners, bankers, and I would say, in my opinion, the former finance minister with the best sense of humor. I remember many years ago, during the travails we were going through, I said to him, "How are you, Minister?" He said, "No, I'm sleeping like a baby." I said, "You're sleeping like a baby?" He said, "Yes, I wake up screaming every 2 hours." So let's get started then with Philippe. Let's start with Philippe. Thinking about those last 25 years, what would you say has been the contribution of the inflation targeting framework to our macroeconomic environment? And just reflecting, as all of us will, on this current debate, what are the two sides to the debate in simple terms? Why are some pushing for a reduction to 3% and others feeling, for example, that they don't want to go in that direction? So over to you.
Thanks, and thanks for having me. It's a real pleasure to be here tonight, to everybody. Yeah. So when we look at the inflation targeting and the contribution to the economy, and we think back 25 years ago, what we had in the economy, and let's look at it, let's divide it up into two periods. The period up to, let's say, 2000 to 2010 was still very volatile in terms of inflation, in terms of the exchange rate, and all of that. And the intention of inflation targeting is basically to stabilize that a bit. And so the one question would be, did it succeed in stabilizing the inflation within that 3 to 6% band? So when you look at the first, let's say the first 10 years, that was still very volatile, many periods going out of it. But the period since, let's say, 2010, 12 till about now, the volatility in inflation has significantly dropped. The average inflation hasn't, so if you look at the first 10 years, the average was about 5.5%. From about 2010 till about now, it's about 5.1%. So that's a marginal change, but the volatility, that first period was a 3.7% standard deviation. That came down to 1.2%. So I think in that, that gives us a bit more predictability. If you're a business person, if you're a person needing to, if you're a working person, who needs to deal with prices and so on, that is very important. Also, I think the pass-through effects from exchange rates to inflation, that still happens, but the periods of instability that brought after the period, let's say after the global financial crisis, since then, it's been much shorter periods of instability. Before that, the periods were much longer. If we talk about the two ways to think, I would divide it up into those who argue that the cost of reducing it from, let's say, 4.5% to 3% to reset the expectations. I think that is maybe the way to talk about it. It's resetting the expectations, because at the moment we are not that far from 3%. Actually, we're just a bit above it. But where are expectations of inflation in a year's time, in 2 years' time? And that is actually what needs to be managed. You can't do anything about the inflation rate today as a central bank.
I'm going to have to come back to you. Everyone has to have a chance to speak.
So it's basically to bring that down, while the other side looks more at the impact on unemployment.
Thank you very much. Shannon, following on from that, what do you think is the likely economic effects of if we had to move to a 3% target?
So we did some work around different scenarios around moving to a lower target. There's a high scenario, base scenario, and a low scenario. In our base case, and this was actually done before they signaled their preference for a lower target, we just kind of had us at 3%, and they're moving closer to 4.5%, but not 4.5% exactly. So structurally, inflation has come a bit lower. But I think the more interesting scenarios are the high and the low. So in the high scenario, which would be almost like your high inflation scenario, you wouldn't necessarily get buy-in from the National Treasury. And why that's important is because there's a lot of prices that they help to set. So admin prices, public sector wages, all those things are going to keep inflation quite sticky unless there's buy-in from the National Treasury. And that would also take some time to work through the system. Where in your best case scenario, there would have been early buy-in. I think that ship has sailed. But if there was early buy-in, we could have really benefited from riding on, improved sentiment coming through in the currency. That pass-through into inflation is going to further help in the short term, and so you can have the structural components of inflation coming down closer to 3%. So those are the two kind of scenarios that we work in, but there's countless scenarios in between the two.
Thank you very much. It's Mamokete, you will maybe tell us about the markets and their expectations in this regard, and the effects on the bond market, on the currency market, and the effects of the uncertainty in this area from your perspective.
Okay, so the market, there's two things that drive how markets then, internalize the change in the inflation target. The one is really about where inflation actually is, and then the other one is, how credible they believe that, the SARB is going to be around the long-term inflation target, because there's what's happening at the short end of the bond curve, and there's what's happening at the back end of the bond curve. And the back end is driven much, much more by long-term expectations, which are much more responsive to the credibility around the target. So what we saw happening this year is because the Reserve Bank moved initially without getting the buy-in from Treasury, or at least it wasn't obvious that Treasury was supportive of the adjustment in the target. We think that that could have delayed to some extent, how quickly the bond market moved. But you still had a move. It was around 50 basis points. So if you think about it, this was 150 basis points in total in terms of the adjustment of the inflation target, which should, in theory, if you had a complete and utter conviction around, you would see a similar adjustment in bond yields. But we saw about 50 basis points when the Reserve Bank initially put the preference forward. And then when Treasury sort of came back and said, well, they're not going to push back that much, at least the language softened around that, we saw another 50 basis points. So the market is not going to fully internalize 150 basis points until you have seen probably another cycle of inflation, and the Reserve Bank has successfully, gotten inflation over the long term at 3%, and also, most importantly, acted in the interim in ways that are consistent with getting inflation to that level.
Right, thank you so much. I'll come back to you on some of those thoughts, but let's hear from Daan and then from Mr. Nene. So we've heard this mentioned earlier, this question of expectations, and you've highlighted in your research the importance of expectations. In fact, inflation targeting is often seen as a communication strategy, a way of managing expectations. So maybe just talk about that and how you see the role of expectations.
So expectations are really important to the calculus of how difficult it'll be to achieve a lower target and how much what that will cost. So the difficulty with inflation expectations is that they're not directly observed. So we have to try and measure them either through things like surveys or, as Mamokete said, by trying to imply them from market pricing, usually using a model, which means that economists will tend to disagree about any measure of inflation expectations, and there's uncertainty in South Africa about how long it will take to bring inflation expectations in line with a lower, different target. What we've seen historically is that it has required extended periods of low inflation for inflation expectations to persistently shift lower. So we saw when the target was changed last in 2017 to a midpoint of 4.5, it took about 4 years for inflation expectations to actually re-anchor to the lower level. And then we actually saw in the post-pandemic cost of living crisis, we actually saw inflation expectations then de-anchor again when inflation started picking up. And so why this matters is that history shows us that we will need to see inflation persistently near the target for inflation expectations to anchor to a lower level. Now, in the current context, SARB's own forecasts show that inflation is expected to pick up over the rest of the year. And so in order for inflation expectations to come down, we're going to have to see either tighter policy or policy remain tight for an extended period, or we're going to have to hope for some good luck. And so I guess we'll get into that a bit more, but for there to be a low-cost transition to a lower target, managing inflation expectations is going to be incredibly important, and that's where communication from SARB is going to be particularly important.
Why does managing expectations lower the cost of reducing the target?
Because they affect wages, because of wage demands, and also the way firms set prices. So there's in South Africa a lot of indexation built into the way that wages are set, and because those are often based on historical CPI outcomes or expected CPI, that's built into how prices are set, or wages are set, and the same is true of prices.
Thank you so much. So, Minister Nene, former Minister Nene, I saw in some countries inflation was very unpopular. The price of eggs can lose you an election. So I'm not quite sure from a political perspective, political economy perspective, inflation is not popular, but inflation targeting is also not popular. So how do you square that circle?
It is a very complex one, Kenneth, if I were to say. But at the end of the day, in the final analysis, the goal of macroeconomic policy has got these two pillars. I mean, with its two pillars of fiscal and monetary policies, we need very strong coordination between the two. And unfortunately, the other one is very much exposed to the political noise, with the other one, being able to focus on monetary policy. But also the periods of reporting for those two are not entirely aligned. As you would know that with the central bank, you would get a series of communication that goes out there. And it actually flies a bit above the head of the people that are mainly affected by the fiscal policy directly. So you'll find, if you were to look at the quarterly report of the central bank, with fiscal policy being actually having only perhaps two periods or reporting periods, which would be at the tabling of the budget and the medium-term budget policy statement. And you'd find that the Minister of Finance would actually be very cautious in making any profound announcement other than during those two periods. So that does provide, and that's where coordination becomes critical, so that even if the noise of those who might be for inflation targeting, at the end of the day, inflation actually, because it protects the buying power, even the people that it actually serves their interest the most are the ones that least understand, monetary policy in a way. Because there is only one instrument, and that instrument would actually be interest rates.
From your experience, given those shortcomings of the cycle and the reporting time, how do we coordinate monetary and fiscal policy in South Africa? What process happens?
Look, that's also written in the Constitution itself, that even though the central bank, in executing its mandate of monetary policy, it has to have regular consultations with they would put it in our Constitution, it says, with the minister responsible for national finances. But that does not only happen between the two principals, which would be the governor and the minister. Even officials themselves would actually have to find space to be able to coordinate how fiscal policy, because we might actually be sitting at the Treasury and talking about an expansionary fiscal policy, counter-cyclical in a way, and on the other side, with the central bank looking at tightening a monetary policy, those two, if they are not properly coordinated, might actually conflict.
Thank you. I'll have a proposition, maybe Shannon or Philippe can respond. I've been involved in heated debates. On the one hand, you've got people who say we need to reduce the inflation target because we'll bring down inflation expectations and the cost of borrowing will go down and you'll have massive fiscal space because you'll have fiscal space. You must do it. And then the people on the fiscal side say, but you're going to make it really hard for us to have a credible budgeting target here. We're not going to meet our budget target, and therefore we're going to have less credibility. You need to give us time. So there's a real debate. Maybe you can reflect on that. Start with Philippe.
Well, maybe briefly. So, in a sense, when you think about if you talk about, let's say, fiscal policy, there's the 3-year medium-term planning. When you think about inflation targeting, you can talk about 1 or 2 years going forward. So it's about coordinating those things. So I think when one talks about resetting an inflation target to 3%, remember in 2000 when we introduced it, the first target was set for 2002, not immediately. And the same thing will happen in this case. And in a sense, given the impact that fiscal policy can have on monetary policy, if there's too much borrowing in the market, etc., pushing up, being inflationary, there might be an opportunity to coordinate these two things a bit more.
So are you saying that the fiscal policy might want to spend more, and that will cause inflation, and therefore they might not want the inflation target to be lower?
Well, well, I'm not saying that is the case, but that could be a case. So we know that in South Africa, fiscal policy does have an impact on inflation, and the numbers bear this out. The deficit has an impact on that, and also on inflation expectations, particularly 2-year ahead inflation expectations.
Lecturers should demand 3% or 6% wage increases.
3% if we want to do this.
Shannon, do you want to reflect on this debate as well, please?
I think the one thing I can just add is also just from the perspective of why is it not popular in the near term. So if you look at revenue collection, which is largely what the Treasury is kind of worried about at the moment, a lot of that depends on what your nominal GDP is doing. And that, again, depends on what is happening in prices and things like that. So in the short term, your fiscal metrics could look a lot worse. And with that, there's still going to be increased spending pressures. So that's the difficulty that I think the Treasury is facing, and we must also just appreciate a little bit.
I think repeat that again. So you're saying that if there's inflation in the system, then the government will take in more taxation and it'll be easier for them to achieve their budget targets.
Yes, kind of. In the simple.
And then what's the long-term effect of that on the economy?
So the benefits are very clear, but it's the short-term costs that everyone is quite worried about, especially.
What are the benefits?
I think Mamokete already.
Just repeat. What are the benefits of the 3%? Thank you.
So, I just want to weigh in on this debate about the cost, etc. The one thing, if you look at South Africa's inflation, you've been at 3% before. So we've just experienced a period where inflation was around 3%. We'd had 3% in 2020. We've had inflation that has been well below the target before. And it gets there not necessarily because the Reserve Bank is targeting 3, because of all sorts of other factors. What's happening to the rand, what's happening to all of these other things. So when you think about, what you're trying to do is, and especially why the timing can matter quite a bit, is to say, if you're already at 4.5, if you're already at 3, then just change the target, because expectations are in any case adaptive. So if you don't change the target, then expectations are not going to go to where inflation is, which is where you desire it to be. So you then take it there. Then, when you talk about the benefits from a fiscal perspective, it's really about, the cost of borrowing, because if your inflation is 3%, your borrowing rate is going to be lower. So while in the short term, you're going to have this, the negative effect with a country that's running 80% of GDP in debt that has to be refinanced every year.
Say that again. What is our debt?
It's 80% of GDP. We refinance R1 trillion every year.
And how do we do that?
We do it, some of it in the short term, some of it in the repo rate type of market, about 40%, 40 to 60% of it at the back. So there's that debt that we're refinancing every single year. So when you reset interest rates by 100 basis points, it means that about a quarter of the debt is getting refinanced at a lower rate. So that ultimately will accrue back to the fiscus. And it matters what your debt level is. If your debt level is 20%, you don't care. When your debt level is 80% of GDP, it matters a lot. So that's the positive.
That is really clear. Thank you. I'm going to change the subject a little bit back to Daan and just change the subject to be, sometimes you hear that South Africa should set its inflation rate at the same level as its trading partners. Maybe just spend a bit of time to explain why people say that and what you think of that.
Yeah, so I think other people have mentioned that our current inflation target, or the range of our inflation target is higher than many advanced economies and leading emerging markets. And so our average level of inflation has historically been high. And what that happens as a result is that the currency tends to depreciate over time relative to countries that have lower inflation. And so, the problem with that is that it makes ultimately the economy less competitive over time as the price level in our economy rises as our import costs go up, and our real effective exchange rate. So the exchange rate, once you adjust it for the relative price levels between South Africa and our trading partners, that tends to actually be fairly stable while the nominal exchange rate depreciates. This makes us a more expensive economy, a less competitive economy over time. So a lower average inflation rate would be desirable overall, but announcing a lower inflation target isn't a magic bullet to achieve better competitiveness. There are a lot of...
What else would you do structurally?
So we've touched on the difficulty in anchoring inflation expectations. So part of that difficulty is that we have other factors that contribute to high inflation in South Africa, particularly things like high administered prices. So think of electricity and water, and government-related prices have been increasing at more than the top end of the inflation target. Fixing that is going to require a mix of economic reforms and public finance reforms, which are not easy. And then there are all the other structural things that affect competitiveness and productivity, all the things fixing the things that have made it hard to invest or unattractive to invest in South Africa, and have contributed to our poor productivity performance. So it's all the macro reforms that everyone keeps talking about.
Great, thank you so much. Nhlanhla, Nene, maybe to come back to you with regard to how we communicate this in the popular imagination. You know, when we're talking to the people who are not the people in this room necessarily about macroeconomic policy, about low inflation, about the role of low inflation and prudence. You were a prudent finance minister, and prudence. What is the role of that? Because it seems counterintuitive, where people would like to see spending and higher wage increases.
Yeah, I mean, in addition to administered prices, it is higher wage increases, which would actually be a huge contributor to the very same inflation that we actually are trying to anchor. And more often than not, unfortunately, it would be the organized constituencies that would actually be, whose voices would be heard. Not only, the labor side of it, but also organized business also has, are better able to communicate what would actually be in their best interest. So I think the difficulty then becomes managing that with, the entire political spectrum, trying and keep, wages at a level, at an affordable level. If you look at the previous years, if you actually were to just step back, we actually have almost doubled the rate at which the wage increases have been, especially in the state. And what would then happen is that would also translate into higher wage increases even in the private sector as well.
Thank you very much. So in a few minutes, we're going to be opening up for questions. There's just a few minutes left. So I would like to put you each on the spot, I suppose, and ask you if you were called into a meeting to mediate between the Minister of Finance and the Governor of the Reserve Bank, and they say, we've almost got to agreement, but we just need to hear what your view is on this matter. Should we keep the inflation range at 3 to 6%? Should we maybe have it at 4.5%, which is halfway between 3 and 6? And does that give us flexibility to have a range? Or do you think we should go to a point target of 3%? What would you actually say to them?
Okay, I'll go first. I think you would have to be a bit sensitive to both people's arguments against and for it. But I would say that what people are very worried about on the monetary policy side is that you're going to get yourself in a situation where you have to have very high and restrictive interest rates. That's not necessarily the case. We've spoken about the benefits it has for your exchange rate, volatility. The SARB is not one of those that will just react to a first round effect. They have always shown prudence in waiting for second round effects, and they would do the same here. When we went to 4.5, it wasn't a huge issue like it is at the moment. I think why it is now, 3% is still technically in the 3 to 6 band. They're well within their means to go for 3%. Why it's a sticky issue now is, number one, it's happening at the same time as other policy debates like a fiscal anchor and officially lowering the target. Could even be 2 to 3% or 1 to 3, who knows? And I think it also matters because we have structural inflation driving us for the next 2 to 3 years. So we've got NERSA agreements for 2 to 3 years.
So I'll take that as a yes.
Yes.
Okay.
Sorry, 3%.
I got you. I think 3%. But then we need to have a conversation about how we're going to do that. And it's not just the Reserve Bank who needs to talk. I mean, the governor talks about, do you know what it means if prices double every 18 years or 24 years and contrasting what happens at different inflation rates. But this is also a conversation that needs to be had in places like NetLag, where we talk about the relationship between labor and business. It needs to be in the press everywhere so that everybody gets the same message. Things like the sacrifice ratio and all of that, that's not set in stone. It's not a law of nature.
What is the sacrifice ratio? The head of school mentioned it.
So that is so if you want to bring inflation down, you might need to increase the interest rate. If you increase the interest rates, it might pull down growth. So it's how much growth will fall to get inflation down by 1 percentage point.
It's not set in stone, you say.
It's not set in stone because if you can reset your expectations, then the amount with which we need to increase interest rates to force it down basically becomes less.
Thank you. Mamokete?
So I hate being like consensus, but anyway, here we are.
I thought you were different.
I know. I'd like to believe I am, but I'm clearly not. So I know. So I would say 3%, and for two reasons. The first one is that it's not clear to me that there is an argument that a higher inflation target is good for economic growth or productivity or capital allocation or anything. And I think, there's a very boring, and we don't mention it, reason why 3% makes sense. It's because our trading partners are there. So it's not even something, the level is not something that South Africa needs to determine by itself. It's sort of like external. So we're not arguing about whether 3% is better than 4.5%. We're maybe arguing about why now, why not tomorrow, whatever the case may be. And I think in terms of the timing, I've mentioned already that when inflation is at 3%, which you didn't help get there anyway, it's probably the right time to try and implement the policy. So if you don't do it now, you're probably going to have to wait for another inflation cycle that pushes you further down the road, whatever. But I think the other important reason why you would want to move it to 3%, and I would say, don't even quibble about 2 years, whatever. It doesn't really matter. The other reason is that markets have already discounted that change. So if you reverse it, it's going to cost you. So unlike before where you were talking about whether to do it or not, now there's actually a cost associated with pulling back, because this is a policy we've implemented. So you're pulling back, there's a cost associated with it. And that cost might be a bit higher than what we would like to internalize.
Okay, thank you very much. Nene, would you like to put your neck out or not really?
It would be very difficult. but again, whether it's 3, whether it is 3, at the end of the day, there would still be a room for a target range as well, because it would be 3 as an anchor, but allowing the error rate.
What's the benefit of the range, do you think?
Absolutely.
You think there's a benefit to have a bit of a range?
Benefit of a range, because you also do not want, you want the flexibility whilst you are anchored, but the flexibility also not to punish a monetary policy in case it slip up.
The
but
flexibility in an uncertain world, I suppose.
Correct, yes. Mm-hmm. But then again, with in the coordination, I think there needs to be an anchor also on the fiscal side as well, and hence the fiscal rule.
Goodness, we haven't spoken about that. We'd have to have another session on that. Daan, do you want to do you have to say what you think?
So a lower target is desirable, but we need a Team South Africa approach. And the problem is that in the absence of coordination between monetary and fiscal policy, and in the absence of the kinds of structural reforms we mentioned, and a social compact, a consensus in South Africa that a lower target is needed, there's a danger that the private sector bears the cost, the burden of the transition. So we could have a much more costly transition to a lower target. And so there is an important conversation to be had about how we achieve a successful low-cost transition. And I think we haven't done enough of that.
Okay, hopefully you'll be able to explain what you mean by the private sector bearing the burden. But I think we hear you saying if it's successfully done, the transition, then it will have a good outcome. So now the public in this room and online will be allowed to ask questions of the panel.
Yes, so what we're going to do now, Professor Rousseau, I see you, yes. We're going to have 2 roving mics. Okay, so for those online, just take a pen. You can ask questions in the Q&A section, and those in here, Dr. Creamer is going to decide who asks questions when. You can do it. I should do it, okay. Can we get another mic? There was another one somewhere. Okay, so we're going to first give preference to those in the room, and then we'll see those that are online that Ezekiel will help us with. Professor Rousseau, can you give Professor... Oh, okay, yes.
Thank you. You've heard my name is Yanni Rousseau. I have to start by saying that inflation is not a policy instrument. Oh, that's pretty obvious. And I'm against it. I believe inflation is ungood. So I want to ask Mr. Nene the question, who should announce the target if there should be an announcement? In 2001, the Minister of Finance announced 3 to 6. In 2002, the Minister of Finance announced 3 to 5, which was changed in 2003 back to 3 to 6. In 2017, the Governor of the Reserve Bank announced 4.5. So should there be a formal announcement? If there's a formal announcement, who should do it? Can the Governor, without an announcement, continue to aim for 3%? I would like to hear Mr. Nene on that. And then anybody on the panel, my second question, is there now a danger that the Reserve Bank may start targeting 3% and the Treasury keeps on targeting 4.5%? And then we have policy chaos. And I will ask this question on the 23rd of October to the Governor at the Monetary Policy Forum. Thank you very much.
We're going to take a couple of hands first and then we'll pass it on. Yes.
Good evening, everyone. Crystal Huntley. So first of all, not because I was asked, but I'm all for low inflation for multiple reasons. My question is on administered prices, and I was just wondering what your thoughts surrounding that was. So because I'm for 3% and I'm for the Reserve Bank getting there, this does seem like it's a risk. Rooted in the fact that administered prices are always cited as an upside risk to inflation. Also, it's always increasing above the inflation rate. And at the end of the day, it's rooted in structural inefficiencies. I've asked this question at an NPR before, and the answer was that usually administered prices would tilt towards whatever the target is. What are your thoughts surrounding this? Could this be a risk when it comes to achieving a lower inflation target? Yeah.
Dr. Creamer, if you don't mind, I'm going to ask Daan to answer that question. Okay, but we're not done taking hands yet. The gentleman with the blue tie over there.
Thank you so much. Anis Foresta. So I have a few questions. I'll keep it to 2 for now. On the point versus range, there's been argument for flexibility from the range. However, there's a lot of research, and particularly the experience of the ECB suggests that when you're clear and you communicate a point with tolerance around it, people tend to understand that far better. And in a country where there's significant financial illiteracy, if you sort of give people a range, let's say 3 to 5, 2 to 4, you can quite comfortably say well, we're close to the top of the band, we're successful, which is the case that we had for quite a while with 3 to 6, near the de facto target. Would it not be beneficial to have a point, but then have sufficient tolerance around that so that you can play around with it and that will add the flexibility, but your communication is a bit clearer? And then on my second question, which will be specifically for Daan, the expectations and its importance for monetary policy. You mentioned the need for the SARB to communicate in a much better way, I would suggest, is what you are getting at in terms of pulling expectations down and anchoring them at their preference. I just wonder, based on the research that's recently come out in the NBER, Kwabian and Gorodnichenko, they sort of suggest that economic agents have this cycle of inattention. And what we've seen is there's been a big shock to inflation. People are now attentive to inflation. Their expectations respond, but inflation comes down. And following inflation falling down, expectations are going down with them. Given that even though inflation is low, certain research would suggest people are inattentive. And you certainly mentioned the track record being important. Would you not think that people are still attentive to inflation, so revising their expectations downwards? And now we have this big policy debate where the governor in MPC press conferences mentions the 3% preference. Would that not sort of convince economic agents, your firms, and your opinion leaders like financial analysts that the 3% is credible and that expectations will come down far quicker than the previous example we have? Thank you.
The range question, I'm going to ask Professor Berger to please answer that question. Spahle over here, you can go.
Good evening, everyone. I had a few questions, but I'm gonna make it one. I haven't heard any of the panelists spoke about it yet, so it would just be interesting to know. So I know there was a lecture that our current SARB governor had. It was at UNISA, and he spoke about inflation targeting, and he said that we are going to target inflation, we are going to lower inflation because inflation affects the poor. Now, we know that a lot of the poor is also unemployed. And, you know, there's been I think perhaps the loudest debate against lowering the inflation target was the leftist perspective that if we lower it, it might affect unemployment and other social issues as well. So given that, you know, South Africa does have such a very high unemployment rate, is there substance in that argument? And also on the claim that inflation affects the poor, I know that former Minister Nene said that you know, that communication does not filter through to when, you know, we do communicate on a regular basis, but it does not filter through to the people that it affects the most, which is the poor. Who does inflation targeting really affect the most?
Okay, I'm going to ask Mr. Nene to please answer both of those questions, the Phillips curve one and the other one as well. Excellent, and then the gentleman behind him. Excellent is, yeah.
I wanted to ask, or maybe there was a debate around the mandate of the SARB, and I wonder if part of the resistance to the 3% target is that it implicitly assumes that inflation targeting remains the only mandate. And so the question is, maybe in the spaces that our panelists are in, is that a question that has been decided finally? Because the two things would be antagonistic to each other if the question is still open.
Yeah, Shannon, if you can please take that one. He wants to know if inflation targeting is the only monetary policy tool that we've got. Maybe just repeat your question. What would be antagonistic?
Okay. No, I'm saying there's a debate, or there was a debate about the mandate of the SARB. Is it only inflation targeting, or does it include economic growth?
Okay.
And so the argument about taking the level or the inflation target to 3% implicitly assumes that inflation targeting is the only mandate that will remain, because if you include growth, then the two would be antagonistic.
Okay, Dr. Creamer will do that one. Yes, behind you.
Hi, I just had two questions. My first question is for Ms. Mamokete. I have this feeling or impression that everybody's anti-high inflation, but we've seen in the past a lot of times in Argentina 2000, USA post-World War II, Germany post-World War I, where they took advantage of the fact that money is an abstract value. We put value on money. So what's your take on debt erosion in the sense that if we put high prices, high inflation, we can, I guess, counter the debt that you mentioned earlier on? My second question is for Dr. Daan Steenkamp. Dr. Creamer mentioned something important, that a lot of individuals outside this room may not have too much understanding on concepts such as the Phillips curve, inflation, etc. So expectation is very important. But the main issue we've seen in the last 20, 30 years is panic has caused a lot of issues with our understanding of inflation, pricing, etc. Especially in South Africa, when a boss says, "Look, I'm going to lower your nominal wage," people go crazy. So, what's your take on the fact that if we can lower prices, we don't need to lower nominal wages, and real wages can kind of go down, and nobody really knows about it? That argument.
Any other questions? Next to him, yeah.
This question is to anyone on the panel. South Africa has extreme wealth inequality, and it's been an issue for many years. And I wanted to ask, what are the effects that aiming for this 3% inflation rate could have on wealth inequality in this country?
Shannon, do you want to do that? Are you comfortable to do it? Okay. Mpumi.
Good evening, everyone. Mpumlelo Selani here. I don't know if this has been addressed by the panel as of yet, but my question is, have the short-term costs of a lower inflation target been considered? So for instance, when we look at the competitiveness for our exports will be reduced because we're going to probably have a high exchange rate. We might likely in the short term experience a higher debt to GDP because GDP will probably not grow, from the sacrifice ratio that one of the panelists spoke about. And then the potential in the long term for hysteresis, where the natural rate of unemployment increases over time due to us, having such a low inflation target. So I just want to know have there been contingencies that have been thought of by the panel to mitigate these short-term costs? So yeah, that's my question.
Thank you, Mpumi. Yes, Karen, I think that will be the last one. Am I mistaken? Okay, there's one more and then that's it. Karen first and then the lady, yeah. Karen, can you get a mic? Oh, okay. Can you stand up, please, Karen? Sorry, I've been asked to ask if you stand up when you talk.
Thank you. Thank you. So in the context of your recommendations, very briefly, and the question for everybody, which economic reforms do you think are crucial for your recommendation to have the desired effect on growth and jobs and other things needed in this country urgently? Thank you.
And then there's one last one over there.
Hi, everyone. So I think it was Mr. Nene who spoke about that he was in for the 3% inflation target, but he said there needs to be an anchor on the fiscal side as well. So my question is, what specific fiscal policies or measures do you think are the most critical to complement the Reserve Bank's move to a 3% target? And how can the government and the Reserve Bank work together to ensure that the 3% is credible and effective?
Thank you. I think we'll start from Dr. Creamer and work our way down with the questions.
Thank you very much. I volunteered. I couldn't resist. Some of my students are here, and it's nice to see them, and I always answer them. So the question really that is interesting is the person who says to us that if we choose a 3% target, then we are explicitly saying the only job of monetary policy is to target inflation. It's got no other target. It's got no other objective. And I would like to say that that is not a correct perception, because the reason, if you read the Constitution, it says we target inflation, or we target the value of the rand in order to facilitate growth. Okay, so there's a long literature on this matter, but the inflation targeting mandate is for the purpose of growth. It's not for its own purpose. Other countries like the US, they target both of them. So in the short run, they're targeting both of them. In the way that we've conceived of it, and many other countries, is you target low inflation because this will be good for investment, because it'll hold down inflation, hold down interest rates, and hold down long-term interest rates, and that stability will bring growth and employment. So it's a false dichotomy in that sense. It goes to, and other members will talk about the Phillips curve. There was a short-run Phillips curve relation where you think, well, inflation is good for employment, but in the long run, it becomes vertical and the trade-off goes away. So I think we probably will still have that debate in South Africa about changing to a dual mandate. We want to look at inflation and jobs and growth because of the crisis that we're in. But theoretically, you actually are achieving both of those targets. And the role of monetary policy is specifically that target, to contain inflation for the purposes of growth.
Shannon?
So maybe just to stay on this question, the SARB's dual mandate or possible dual mandate, what that could be. So there was a big debate in the middle of the 2015 onwards or so about targeting unemployment, and it specifically came from trade union pressure at that time. We did, with you and you wider a paper at that point, a paper on whether the Taylor rule could be changed to something like measuring it against the unemployment rate, using inflation expectations a bit differently, using trade union expectations versus businesses versus analysts. And I would say that there's not a lot of merit in targeting a certain kind of unemployment rate or job because growth rate, because like you have already said, the whole point is to create a stable macroeconomic environment. Once you have that pillar, it's actually not even a pillar, it would be a foundation for growth to come from. And I think it would complicate this a lot, because then you're going to start getting into a debate on how do you correctly measure it, because I mean right now the debate is what is the actual unemployment rate. There's a 10% floating around, so is it being measured correctly? Then you're just going to get even messier. So I think when you have a focused mandate, it's a lot easier and other things come from it. The governor himself always says that they have this one mandate, but it's to help support growth and jobs and things like that. And then just also linking it to employment, I think what we're seeing a lot coming out of universities, because we do work a lot with graduates, and the one thing that graduates often get stuck on is what comes first, growth or unemployment? One is a symptom, one is a cause. So if you can get growth going, unemployment will improve. So I think that's just also important to remember. And then the wealth inequality, the impact on wealth inequality. And I think this again links to inflation is bad for the poor. This is, for me, it goes back to the growth story. So high prices are really harmful for households. If you look at their budget, most of their budget goes to very high inflationary goods that are exposed to currencies. So most of their budget goes towards transport and housing and food. And those are all exposed to very volatile type of shocks. Food prices, fuel prices moving. So if you can anchor inflation lower, you could have exchange rate volatility coming lower. Shocks would not come through as harshly and impact the poor on their budget, what they feel. So I think that's also what is beneficial to bringing down inflation, is helping wealth inequality and achieving the benefits that come with that.
So maybe just a few of the questions on the point versus range thing. I would think a point. One can say, of course, we need to understand that there will be movement. This is not a flatline thing. So as long as it, let's say, 1 percentage point either way of the point, we're not too worried. If things maybe move outside that, we need to, as Governor Mboweni always said, invoke the explanation clause. And why is the point important? Remember in the beginning when we had a range, people talked about the hardening of the upper bound because, inflation fell just within that 6%. And then we said, oh, okay, it's fine. And then it slipped out again. And then, and then if you look at the average, even in the last, since 2010, the average has been 5.1. So it is always in the upper half of the range. So rather than go for the point. In terms of the reforms that Karen was asking about, I think on the administered prices component, that's where the biggest reforms should. Well, all sorts of administrative, not just electricity. So there are things that we need to look at competitiveness in markets. The electricity is one case. I mean, we can talk all evening about that. How do you build competition into that market? But even your petrol price, I mean, that's set, it's administered, somebody announces it. So all of that other reform, and that goes to the question about the fiscal anchor. I think it is, given the impact that the deficit has, as we mentioned earlier, on inflation, I think there needs to be some alignment there. If the fiscal anchor, if we can reach that, that will indicate support from the fiscal side. That complements the monetary side. And you're right in terms of the wealth effect. I think it's important. What struck me from the American election last year, they didn't talk about inflation. They talked about the rise in the cost of living. For most people who are not listening to economists every day, the word inflation is a bit abstract. Cost of living, that speaks to everybody. That's where even the cost of eggs. And that really affects rich people. They can protect themselves, invest their portfolio overseas, and that's protected against inflation. Poor people can't. They face that higher price of eggs and bread and maize and so on. And that is, and there we need to really think about what time does it take for inflation for the price level to double. In other words, we need to get to a price level we do not worry about inflation when we take our decisions about where we invest, what we buy.
Okay, so I'll address the question that was asked to me directly around why it feels like people are anti-high inflation, and that inflation can actually be quite useful, especially when you have very high debt levels. That only really works when you have trapped cash, where you can trap investors in your instruments. The minute you have an open financial account, which is what we have, as in people can take their savings out, etc., what that leads to is an immediate fleeing of capital, and that will be for both locals and offshore. And we've got quite a lot of offshore investment, both in our equities and in our fixed income and in our bond markets. So you can really, as a policymaker, only get away with that if people don't expect it. But the minute people, you do it maybe for a period of 1 year, you get away with it. But the minute people reset your expectation for inflation higher, they're going to start charging you a commiserate amount for whatever that inflation is. So it doesn't really help. So right now, trying to inflate your way out of debt is not a strategy that is available to any policymaker. Because trust me, given debt levels all over the world, if it worked, people would be doing it. Because everybody just wants to get out of the debt piles that they're in. Then, of course, the other issue is that you're distorting capital allocation greatly, and you didn't have to go far to look for an economy that's trying to, push inflation. Zimbabwe's one, but I'm going to talk about Turkey because Turkey is kind of like semi-functional and they're actually continuing to deliver growth. Having said that, though, for people who cannot insulate themselves and protect themselves via, investing externally, etc., it has destroyed people's lives, that inflation. So it's not an available strategy, and I know it keeps coming up as why don't we do this type of thing, but trust me, it's not available. And then the other thing that I think we're losing in this discussion is the fact that globally inflation has come down a lot. So the low inflation, the low inflation that we're dealing with in South Africa is not an exception. So when we fail to say this is our target, it's 3, all we're failing to do is to get our expectations in line with actually where globally inflation actually is now. So if you look at aggregate levels of inflation globally, they've come down by a lot. I mean, emerging markets have come down from an average of 10 to an average of 3. So our 4.5 sticks out. And it's only at 4.5. Inflation tends to be sticky in South Africa to some extent because we have not made that policy adjustment. And I think that is something we also have to keep at the back of our mind, that it's not going to cost as much as it would have if we were at 10, partly because globally inflation is already quite a bit low.
Thank you. The Section 224 of the Constitution, it was very carefully crafted. And I really commend the drafters because when they said the primary object of the South African Reserve Bank is to protect the value of the currency in the interest of balanced and sustainable economic growth in the Republic. It goes on to say then that it must, in support of that. But then to answer Yanni's question with regards to who should announce, I think the question should be more about how do we arrive at because policy is set by government, but this coordination between between government and the Reserve Bank becomes critical in that whatever is announced should be what is agreed upon through this consultative process. So remember there was a time when there were those 3 TMs in the country, Thabo Mbeki, Trevor Manuel, and Tito Mboweni, where Tito was very clear. He said, monetary policy, Trevor, you cannot enter that fray. And when it comes to fiscal policy, I will not enter your fray. But that actually, it depended on the strong personalities that those 3 had at that time. But proper coordination becomes an issue, and I think it is for that reason that during the budget process, the chapter that actually would talk to that part should actually be written together between the minister and the central government and the governor of the Reserve Bank. So again, the other question, I think it has been responded to with regards to inflation, actually how it impacts on the poor, because at the end of the day, you are protecting the value of your income, and it is for that reason that I think communication, and I think Prof has put it well when he says maybe it is the words that we use in explaining what inflation is, rather than focusing on inflation. We should be talking about the cost of living, which is much easier to explain, because if you're talking cost of living, people should understand that it impacts on the value of the money they are carrying. Short-term costs have also been responded to. I would imagine then the fiscal anchor again has also been responded to, because I think it is important for the fiscal anchor to be there in order for us to be able to find a fair play in terms of coordinating the two.
Daan, when you respond to the question on administered prices, if you can just give a brief definition of what that is.
Great. Okay, so I'll react to the admin prices question. So administrative prices are a range of government-related prices that are set by government. So you could, fuel prices have been mentioned, electricity prices, water tariffs, but there are a range of prices around in the economy, depending on the measures you look at, but it's about 12 to 14% of the consumer price basket. Now that might seem like a small proportion, but those categories impact all sorts of other costs in the economy. You can think of, if you run a business, if your electricity costs affect your cost of doing business. So if we think about the implications of having persistently high public sector costs, it means that in order to achieve a 3% inflation target on average, we need to run private sector inflation at about 2.5% after you've stripped out the exchange rate. Right? So that means an even lower private sector inflation target. And that's not even looking at the other components of consumer prices that are also have tended to grow above the top end of the inflation band. So what's really important is the things that were mentioned about dealing with those sources of inflation. And I think that some of them are really difficult and will take a long time, but we need to be, as part of this conversation, we need to begin having a conversation about what it will take to help the central bank achieve a low target sustainably at low cost. I think the other thing that, responding to the inflation expectations question, I think it's important to note what the other panelists said, that the fact that rich and poor people experience different levels, average levels of inflation, and that the volatility of those levels are different, means that, and the same is true of firms as well, means that there's going to be disagreement about when it comes to price setting and wage setting. And so there's a communication challenge that Saab and other policymakers need to engage in. But more, because we can see, for example, if we look at the surveys of financial analysts, those expectations have come down much more than expectations of others. If you believe our models, then long-term inflation expectations that are embedded in asset prices are also coming down encouragingly. But we need to have agents in the economy, so households and firms, believe and understand what a lower inflation target would mean. And so that means engaging with organized labor, it means engaging with the public, it means engaging with regulators. And achieving a social compact around something like this is difficult, that there's really difficult political economy challenges. But countries that have had much bigger problems than us, countries in South America, for example, that faced hyperinflation, part of the way that they overcame hyperinflation was by having agreements between the central bank, the fiscal authority, and organized labor, where you say we acknowledge the impact, that the transition costs that are going to occur, and we are going to make sure that that real wages are long-term going to be protected, but there's going to be some short-term pain which we bear to enable us to realize the long-term benefits of the change in the policy. I'm not saying that's easy, but we should be trying. I think then, just to finish off on the inflation expectations, but I think, and to link that to the fiscal discussion, just to close off, the danger of not coordinating fiscal and monetary policy here is that, and Mamokete and others have touched on it, is that if we have a worsening fiscal situation, we won't see the benefits of lower borrowing costs because our credit premium on the long end of the yield curve will blow out. So the assumption that we are going to realize lots of short-term economic benefits from a lower target are conditional on fiscal policy being supportive of monetary policy. And of course, that requires some very difficult fiscal challenges to be overcome. It requires coordination amongst the GNU partners. Again, not easy, but if we don't have a sober conversation about what it will take for us to achieve a low-cost inflation target reduction, there's a risk ultimately to Saab's credibility, and there's a risk that we're going to have to see much tighter monetary policy for much longer, and then a real economy cost to the transition. So I think these are important things to be discussing.
I think the conversation can go on for a very long time, but we're slightly over time. And I just want to take 2 questions from online. And then those of us who are in here in person, there will be time to network and ask more questions. Ezekiel, just 2 questions, and then I'll decide who answers it.
We have 3 questions. I'll ask 2. We have a question from Jared Osoro. He's asking on the speed of adjustment, whether when you have, he says, does the reset of inflation target and consequently expectation work through the system faster when the central bank has a single mandate as opposed to the case of dual mandate? And then the question from Minel Gaza, she says that what should a neutral interest rate become if we focus on the 3% inflation target? Do we even have the neutral interest rate, and how will this affect our fixed income markets?
I think the first one was answered by Dr. Creamer, so we can ask the second one. And I'm going to ask Professor Berger to answer the one on the neutral rate.
Yeah. Oh, so the other question is from Lon Wabo. He says South Africa has maintained an inflation target framework to stabilize prices, but at the same time, our debt to GDP ratio has climbed, much like the US, where the concern around the rising debt levels, which is a generational issue. Given this context, how should South Africa think about inflation target and debt sustainability?
Shannon, can you do that one? Thank you. And then we'll close off. Professor Berger, then Shannon.
Neutral rate is always a dangerous territory. So I'm not going to give you a particular rate. It really depends on, because it has various components. So there's the inflation component, but there's also the time value of money, but then there's also a risk component. And I think that's usually the joker in the pack, is the risk component. But having said that, if we can get a lower inflation range or target, let's say at 3%, if we can translate that also together with a more stable fiscal environment where we can arrest our rise in debt GDP ratio, I think that neutral rate will certainly come down. I mean, we've already seen market rates coming from 12 to, what is it, about 12 to 9 now. So yeah. But it all depends on that risk premium.
Shannon.
So the question on inflation targeting and debt sustainability, I think during the time we've had inflation targeting and inflation coming down to the midpoint of the target range, we've had this blow up in our debt to GDP ratio, or not, well, I think it's a bit of a sensitive word to say blow up, but an increase in our debt to GDP ratio. But we have to also think behind the drivers of that increase. And then again, why this is so important that you have that coordination between fiscal and monetary policy, like many of the members have been saying on the panel. But I think if you were to anchor expectations much lower, one of the biggest drivers of the debt to GDP ratio issue being wages and the social wage pressure and all those the exchange rate volatility issues would benefit from a lower target. I think we do also need to recall or remember that the MPC has 6 meetings a year that they can communicate things, and it almost buys them a lot more credibility than someone like a treasury that can only publicly talk about their policy decisions twice a year, in the beginning and the end of the year, but they are running things in between at the same time. So it's not to say that they are also not credible. And I also want to just add that there's a lot more political pressure on a fiscal policy than there is on the monetary policy side. So it is difficult to get that coordination right in this kind of a situation. So I think
Mamokete, I want to give you the last word because you had a thought that you wanted to raise, and then we're closing.
Oh yes. I think also the other thing that we have not explored in terms of I just want to really kill this high inflation story as a solution to anything, is that high inflation is incredibly damaging to savings, and it will destroy our middle class. So it's just not a solution. You talk about it, the only people who might be able to duck the consequences are the very rich. So, it will hollow out your middle class. It will destroy, the purchasing power for the very poor people. So it really is not a solution. And then the other thing that I wanted to say, like as a closing point here, and I think it speaks to the whole issue around policy coordination. Obviously, it's important to get all the other policies aligned, but of all the policies that we need to think about as South Africa, this is probably one of the least important from a macroeconomic policy management perspective, and actually from an economic growth perspective. So we also need to keep that in mind, that in terms of all the things that we should be spending time on, this is probably very, very far down the list. Structural reforms are much, much more important, and actually much, much more important for getting the inflation story right as well.
Thank you, everybody. Our panelists can take their seats whilst our Dean for the Faculty of Commerce, Law and Management comes up to give closing remarks. Thank you so much.
That's great. What a wonderful way to demonstrate macroeconomic thought leadership. And who knew that monetary policy could be so exciting? What a lively discussion. But I'm sure you can all agree with me that the panel's done a tremendous job giving us a real masterclass in economic analysis and policy deliberation. So please, another round of applause for our moderator and our panelists. But this wasn't just an ivory tower academic discussion. This evening's discussion hits at the heart of our well-being as a nation, helping us to connect the dots between a complex topic like inflation targeting with what we all experience and can relate to in economic growth and unemployment. And when I was invited to offer a word of thanks to conclude this evening, and I saw the topic, I decided, I'm not an economist, my field is information systems. So I decided that as an information systems scholar, I needed to have a conversation with AI about inflation targeting. And so I went to my favorite AI chatbot and I said to it, is inflation targeting a good thing? And it said to me very confidently, yes, and I'm quoting, inflation targeting is generally considered a good and successful framework for managing economies. And then it went on to summarize much of what has been spoken about this evening in relation to anchoring expectations, lowering interest rates, debt servicing costs, increasing demand for capital, reduced volatility, etc. And then I said to it, really? And it responded to me, well, actually, inflation targeting is a double-edged sword. And whether it's ultimately a good thing depends on a country's specific economic context and priorities. And then it went on to sour its earlier upbeat confidence with a somewhat grayer summary of various factors outside of central bank control, supply side shocks and administered prices and all of that, and suggesting that inflation targeting could, and I'm quoting again, unnecessarily harm economic growth and unemployment. And it continued that this downside may be, and I'm quoting, especially challenging in developing country contexts. So now I was getting more nervous. And I kept prodding my poor AI tool to give me a more definitive answer, as Kenneth tried to do with the panel. And I think it got tired of repeating itself and, sensing my frustration, finally said, look, it's a good thing if your biggest problem is out of control inflation, and a bad thing if you have other urgent economic dangers like unemployment. The key is balance. And I said to it, I wasn't going to leave it there. I said to it, but I'm concerned about both. I don't see growth, and we may not credibly anchor inflation expectations. So now what? And my AI tool said to me, sorry. Well, that is one of the most difficult positions in modern economics. You are walking a tightrope. And I like the way it said you, as if I'm the governor of the Reserve Bank or the chair of some central bank. And so evidently, McKinley, I think you've picked a stellar topic. Now, we know sometimes AI can hallucinate terribly, and sometimes AI can sum up a problem just about perfectly, only to offer absolutely no guidance. So thank you very much to tonight's human panel, expertly stewarded by Dr. Kramer, for helping shed much critical analysis and insight into how this tightrope might actually be navigated. And I want to thank the panelists, not just for sharing their expertise and perspectives, but for bringing an air of optimism. It may well be possible for the SARB to maintain sufficient credibility to anchor inflation expectations and stabilize the tightrope, letting government sort out the structural reforms with the private sector to unlock our growth and propel us across. So we can remain optimists. Ms. Bold, Professor Berger, Ms. Lijane, Mr. Nene, Dr. Steenkamp, thank you all very, very much. And let me also just add to the former minister, thank you for being such a good friend to Wits. And we always appreciate the role that you played at WBS. Professor Klamprombel, thank you for hosting this important discussion. Our partners, Hans Buehler in absentia and Corin April from the Hanns Seidel Foundation, thank you for your support. All the other honored guests who've joined us, and to the School of Economics and Finance students, volunteers, thank you for planning the event. My best wishes to you all for the continued success of your student society. The rest of the CEF team for the excellent logistics and ensuring a successful event. Thank you especially to those who asked questions and really challenged the panel. Most especially thanks to the students who were asking questions. And of course, McKinley, thanks for the excellent job as MC. Kenneth, as always, what a fantastic moderator. Thanks for the excellent discussion. To all the guests who've attended online, thanks for joining. And those in the room, please enjoy the opportunity for a little networking and some snacks. Take care.